Alright everyone, so let's begin here. My name is John Paul. I'm the founder of DayTradeToWin. The goal is to understand what we're looking at when we look at trading the markets using what I think would be price action over any type of those conventional indicators. So today I'm going to look at a few different things. I'm going to focus on risk. I'm going to focus on risk to reward. I'm going to focus on how and when you should or should not be looking at taking a trade. I want to make sure that everyone has an opportunity to ask questions. And if you do have any questions, you can always contact me at DayTradeToWin.com. Usually within 24 hours, I have a small staff that helps with installation, helps you get NinjaTrader up and running. So there's a small staff, Chad and Victor, which you may or may not have already spoken to on the phone. So to begin, I want to make sure everyone has a good understanding of how risky it is to trade futures, forex, options. So this is risky business, obviously. I want to make sure everyone understands you can't trade with money you can't afford to lose. So please be very careful. Talk to your broker, making sure that you understand everything involved with trading. There's also a disclaimer, hypothetical performance disclaimer. Obviously, everything we do here is focused on teaching you how to trade, so please be very careful when you start. All right, so now to begin, let me just remove here. Looking at the E-mini S&P, I see a few familiar faces here, but I do want to ask a quick question. Is anybody absolutely new to trading and new to day trade to win? That way I can focus on some basics as well. If some of you are already advanced traders or have traded as well, I won't go too much into the basics, but I do want to focus on some risk to reward opportunities here. Mark, Rick, Ron, Sally, Tom, Corey, Jack. Morning, everybody. All right, thanks, everyone. Thanks, Maureen. Okay, so to begin here, my focus as an educator, as a trader, as showing you how I think the market should be traded is not looking at all of these indicators that are here. You see here all of these indicators that exist here. All of these indicators here are really based off primarily the same thing. The market makes some type of move, and as soon as the market makes that move, there's a calculation, and then the market moves and plots something. The problem is it's always behind. So instead of making a decision based on something that is behind, I would say, moving average crossovers, for example, MACDs, I rather look at a few things that I believe are more important to trading. For example, understanding the current conditions. Is the market moving in a faster or slower condition? I also like to look at time and price. I don't like to look at any type of moving average indicators, right? I agree with that. I also believe that when you look at trading in a whole, it's not just trade and jump in and hope for the best. It really should be based off of some type of rules. So everything that I do, everything that I teach really focuses on a rule set. You know, if this is occurring, then I understand I should be doing this, or I should not be trading, or I should be approaching the market in a different way. So really the goal is to have a clearer understanding, not that everything is going to be predicted 100%, but at least understand what is happening in order to make the best decision to buy or to sell, and then take a profit, take a stop, and so on. All right, so now what I'd like to look at is adding, in my opinion, a few things to help me with risk, reward, when to enter, when not to enter, why I'm entering, why I'm not entering. And the first thing I'm going to do here, and some of you may have already seen some of the videos that I have hundreds of videos out on YouTube that anyone can take a look, prior webinars. So here we have this very important tool. It's an indicator called the ATR, but I consider it a tool. I like to use the value of 4 or 5. This is what I teach in all of my classes, whether it's the Atlas line or the Trade Scalper or the mentorship. And this little tool is very important to understand the market. Is it slow? Is it fast? Should I take a certain profit being larger or smaller? Should I not trade? I also like to add the bar timer. So these two very important tools found in the indicator list in every trading platform, whether it's Ninja, TradeStation, Trade Navigator, Sierra, MT4, they all have these tools. Actually, TradeStation did not have, I don't think they do not have it yet, but I offer a free bar timer for TradeStation as well because I think it's important. You can download it at DayTradeToWin free software section of DayTradeToWin. So in this example here, this ATR is telling me, really telling me what the market is doing and how I should approach it. Is the risk to trade larger than expected? Is the market too slow that the risk to me would be a lot of choppiness? So before you look at any market, add this ATR, this average true range. I've been saying this for the last 10 years to everyone, and the feedback that I've gotten, something so simple can really help dictate how to proceed moving forward. And so the idea behind this is to say, if I'm going to trade right here and right now, long, short, whatever the case may be, then believe it or not, you can predict with very good accuracy that the market will move this distance when this candle closes. Now, the reason why I have the bar timer is because I know that in about 3 minutes, just under 3 minutes, that the market will close this current 5-minute candle and a new candle will begin. And when it begins, I can expect 2 points, 2.25 points up or down from wherever this candle closes. So in reality, I can't expect the market to move 5 points, 4 points, 3 points. I can expect the market to move up or down the equivalent of this value being 2.25 points. So as a prediction, I can't say to you, have a 10-point stop and a 10-point target because it may or may not happen. But as a prediction, I can tell you that the market has the ability to move to the 2.25 points up or down. Now this little idea, this small idea, it's not any, miracle or any, major revelation, but this very small idea of understanding where the market could go or could not go allows you to take a specific target, allows you to use specific stops, and it also allows you to say, the market's normal, I can trade. But under certain conditions, if the market is very slow, meaning 1 point or under, or even being, let's say, closer to 4.5 to 5 points, this is the E-mini S&P, it's a little different in other markets, but the relationship is really the same. When the market is at these extremes, then the risk greatly increases. And that's where I recommend staying out of the market. So on a 5-minute chart, using this ATR, average true range of 4, what it does is it takes an average of the last 4 candles and says, well, the market has, on average, made high to low of about 2.25 points. Moving forward into the future, you can predict the same exact 2.25 points, 2.25 points. Now the good thing is that this does not change. I would say it doesn't change dramatically unless there's a news event. So unless the next candle is really big or really small, you really can only expect this value of 2.25 points to change a tick up or a tick down, but not change that dramatically that it will make this big impact on our prediction. So if the next candle is smaller, you may see 2 points instead of 2.25. If the next candle is even larger, it may be closer to 2.5 as opposed to 2.25. So it's normal to see 1 tick, maybe 2 ticks, but it's normal to see 1 tick up or down, but nothing that dramatic that it will cause a wrench into what we're doing. And so here, this candle closed, a new candle opens, and it's still 2.25. So I'm always averaging down. The E-mini S&P works in quarter-point increments, 0.25 move. And so let me actually show you that on the dome. I prefer to trade from the dome, but there's nothing wrong with using a chart trader and the dome. I'm just more old school. We didn't have chart trader when I began, so I'm more focused on using just the dome when I look at the market. So let me add here a trading dome, if I can bring one up here. And I'll just start up a new one. I have a few monitors running, so I'm not sure where exactly it popped up. So let me just open up a new dome. Okay, so when I look at this here, you can see that the market is a tick up or tick down, but I'm always averaging down with the ATR. So if this says 2.38, the equivalent would be 2.25. If this says 2.4, the equivalent is still 2.25 points, which is 9 ticks. Now when this moves up or down, let's say it moves to 2. Let's say 2.6 or 2.10. Let's say the market, this little candle here plots and this drops down, then you can say I'm looking only for 2 points as opposed to looking at the full 2.25. So always round down to looking at the market going up, going down, a quarter point at a time. The ATR will help you understand that. Anyone have any questions on that? Let me just make sure this stays on top. Now, if you want to take a look at this here, if you press the space bar, this freezes the price. So you can always take a look at freezing the price before placing the actual trade. This helps you because if you are trying to get this exact price and you place a limit order, it may not give you, because it's moving up and down, especially if it's a dynamic or static, if you don't have one or the other, Superdome. So just hold the space bar and you're able to do that. I'm using Windows 8. A couple other computers, Lewis, use Windows 10 that we have. Actually, the computer I have at home is Windows 7. So I really prefer to use Windows 8, but there's nothing wrong with Windows 10. I'm just more of a privacy freak, I guess you could say, where I don't like to be tracked by the government on everything that we do, and that Windows 10 concerns me a little bit with everything that's out there. So Windows 7, Windows 8, they probably can track us regardless, right? But it doesn't really matter. Windows 7, Windows 8, Windows 10, it works pretty much the same way. But this is Windows 8, Lewis, all right? So when you look at this now closing in about a minute, it's still 2.25 points, and the same idea is true if you decide to place a trade long or short. The expectation is 2 to 2.25 points. Now let's think about risk. Obviously, do we want to risk, let's say, 10 points or 8 points to make 1 or 2 points of target? That is obviously, the risk to reward ratio is completely upside down. So when you think about placing a trade, the first thing in your mind, and the first thing I tell all of my students is, what is the risk? Is the market oversold? Is the market overbought? Am I entering as the last guy, long or short? Or maybe the market is too slow to trade and you're going to have a lot of chop. So again, let's take a look at risk when the market is too slow. Let me just move this out of the way. And let's take a look at risk when the market is too volatile. So if you take a look at when the market is a little bit slower, so this is overnight, last night, and remember, this works the same way on every market. This is not specific just to the E-mini. This is a universal price action method of looking at charts. When the typical market is slower than normal, I need to understand it and I want to stay out of it. So 1 point or 4 ticks on the E-mini using a 5-minute chart is the equivalent of seeing all of this chop. Now if you bought or if you sold, all you have is the market going up and down, here up and down. Very difficult to make heads or tails of a situation like this. So as a reference, it's riskier to trade when the market's slower because nothing happens and you wind up with these little cuts, small win, small break even, small loss, but really nothing to make up for it. It's just your broker making some money off your commissions. Instead, let's take a look at when the market is above 4 ticks or 1 point, which is what I think considered slow, but at least there's movement. And so what's normal is anywhere between, I'd say, 2 points, 2.5, maybe even 1.5 to 2.5. That's considered normal. So whenever the market is above 1 point, you can see that there's movement. But when the market is less than 4 ticks or 1 point, you have this choppy, doji, gaps, very difficult really to make anything out of this. Some of the methods that I teach, especially in the mentorship, are very well rounded. They're not just trend following, they're not just breakouts, they're not just counter trend. They incorporate all of those methods into one complete system. So the idea is to understand how to trade breakouts as well as trends, as well as counter trends, and know when to stay out. So if the market's slow, stay out. At the same time, if I show you here when the market is closer to 5, closer to 4.5, 5 points, let's see if I can find here a day where this is actually closer to 5 points. You're going to see that there's an overreaction. This is 4.5, so let's take a look at this. This happens to be October 4th, just a few days ago. You can see these large swings that are occurring, maybe news, maybe FOMC, maybe Janet Yellen is speaking. So if you try to trade under these conditions, right, see the ATR here closer to 5, I want everyone to think about this for a moment. It's not as simple as saying I want a specific stop on every trade that I take. I wish it could be that simple. But if I know that the movement in price is equal to 4, 5, 3 points, my stop, where I say the trade's not going to work, I need to get out of this losing trade, it really does have to be more than these current conditions. Because as an example, this high to this low happens to be a total of 7 points. It's a lot, right? If you have a stop that is less than 7 points, look at, let's say you went short, right? Let's say that you saw this candle and you said, you know what? This is a great opportunity. The market's about to take a nosedive. Let me go short, right? Why not? But if I know the market is able to move this distance, then if I have a stop that's 1 point, 2 points, 3 points, 4 points, it's completely possible that just the randomness of the market moving up and down and up and down into the future will stop me out. So if you decide to go short when this candle closes, the next candle popped up and the next candle made a move in the opposite direction, that is 4 3/4 of a point. So if your stop is less than this value, you can see how easy it is to get knocked around and chopped up with the market moving in the opposite direction against you, equal to or more than what it's currently doing. So when I tell traders, when you initially enter into the trade, please use a stop that is more than the current conditions so you can stay in the trade. It's not because I want to get stopped out at that value. It's because I want to be able to stay in the trade while it works itself out and goes into the direction that I need it to go. But if I know that the market is able to move 4 points and my stop is 2, this is just going to run you over 2 points, 3 points up. It'll just knock you around. So if the risk is too much, right, the theme of this webinar is risk. If the risk is too much, if you don't want to risk more than the current conditions, then by all means, don't take the trade. It's a situation where it's more volatile. The same thing right now, if I add the Atlas line to my chart, and I look at a trade, go long, go short, whenever the Atlas line decides to give it a signal, I know already that the current conditions happen to be close to 3 points. So if I do place a trade, it has to be more than a 3 point stop to even stay in the trade. It's got to be staying in the trade. If you have a 1 point stop under these conditions, expect to just get knocked out and run over. So risk is very important, and never risk more, in my opinion, than 5 points on any trade. So usually what I like to do is I like to double the ATR up to a maximum of 5 points. So currently the market's trading at about 2 3/4 of a point. That means 5 points maximum stop. If the market is slower, it's relative. If, let's say, the trade happened here earlier at a 1.25, you double that to 2.5, you're risking a stop that is relative to the current conditions. So you never have to risk more than you need to. You never should trade under a condition of a smaller risk or loss compared to this ATR. Because everybody wants to pick exact tops or exact bottoms, but the market doesn't work that way. And it definitely doesn't go straight up or straight down. It moves and gyrates like this. Any questions on this? Sally, Tom, Ron, Paraminder, Lewis and Lou, Breva. So to me, risk is very important. Stay out of the market when it's trading above or closer to 4.5, 5 points. Stay out of the market when the market is slower. When it's closer to 1 point or less, you have a lot more choppiness. News. News is a problem. You can have news that doesn't impact the market, and you can have news that absolutely runs you over. There's no way of knowing, us on the outside, that is, knowing when or what I should say, not when, but so much to know when the news will react based on the report or based on what you're seeing. So if there's a news event about to come out in, let's say, 2 minutes, there's no problem trading, no problem whatsoever trading for 2.5, 3 points. But as soon as that news event comes out, please stay on the sidelines. Wait for the move or the chaos or all of those market orders to impact what you're seeing, because once the smoke clears, it becomes very clear what to do next. But if there's a news event that all of a sudden you're short and it pops up 8 points, that's not a benefit to you or to anybody if you're short. So it's always better to stay out of the market until 5-10 minutes. The smoke clears, now everything's back to normal, because a news event can impact the trading. So I have a few videos out there, especially the free videos that I offer, that show you a simple method on how to look at news, stay out, do the opposite of the initial reaction, and all the rules are there. I try to make it as black and white as possible. Now, when you look at overbought and oversold as far as risk, unfortunately, when you look at knowing that the market will continue lower or not, becomes a hypothetical. We don't know if it's going to continue or not. But I'll tell you, if you enter closer to where the market is breaking out, or if you enter closer to the start of a pivot, or if you enter closer to the start of a move up or down, the chances of you getting in better position for it to continue exist. Now, when you look at entering after the move has already started, understand that it may be over. The move that you're looking to catch may be finished or just about finished. So you're the last person buying or selling. How do you know? So for example, the Atlas line gave just now a short at 21.10 Now before you enter short, know whether it's overbought or oversold. It's very simple, and the best thing about it, it's based off of rules. And if you look at the ATR, you have already an expectation of what it can do. So who can tell me, based on just a few things that I've mentioned, what the expectation is moving forward for this market to move lower as a profit target? What do you think? Who knows? Some of you know. I know you guys, some of you know because you follow me. The ATR has this value. So what can you expect? Exactly, 2.5 points. You can expect 2.5, 2 3/4, but not 3 and not 4 and not 10. But you can expect this exact value. So what does that come out to? Well, if you look at this entry, 21.10 and you look at, let me just add here, I can expect the market to move to this value right here, 21.75, 21.775, 450, right? This is predictable. I'm not guessing. I'm not thinking that it's going to make 30 points. This is a prediction based on what the last 4 candles have shown me that is possible. So if you're ever looking at a specific target, don't guess. Don't take that risk of hoping it's going to get there. Instead, take a look at it in a different way and say, you know, I don't know if the market's going to make 4 or 5 points, but the chances of it going equal to this value exist. Let me take this target, maybe even a tick in front of it, front running, which is basically a tick in front of it. So instead of 2 3/4, 2.5. These are all things that help you manage your risk and really take away the guessing games. Now, as far as a stop, you have to have a stop. So please don't ever trade naked without any type of stops. What would be the stop in a case like this? If I'm always risking more than the current conditions, and it's relative, and I'm never risking more than 5 points, then I already know that 5 points, if I double this value, is the maximum I'm ever going to risk on this trade. Not 10 points, not 20 points, it's 5 points. Questions, anyone? Lewis, questions? Or Lou, or LK, Corey, Jack, Breva, Valter? Now, how do I know if the market's overbought or oversold? Again, even though you have the signal, right? So the Atlas line, the software that I offer, gives you specific signals. You know the stops, you know the targets based on the teaching that I do. I also include live training with every trade scalper or Atlas line. Not only do you get a previous training video, but I also want to get with you live to make sure your questions are answered. So when you look at being overbought and oversold, again, it has to be in relationship to everything that is happening. If this entry that you see here on the Atlas line occurred all the way down here, let's say there was a very large red candle, what exactly can I expect the market to do? Can the market continue from where this entry occurs and then it continue? That's the great question. It is really looking at whether or not it's going to continue. So overbought and oversold absolutely have to take into consideration whether it's going to continue. So the way that I like to approach it is I like to approach where we enter, wherever the signal is. In the Atlas line here, it was 21.10, and look at where, in fact, it's coming from, which is the Atlas line at 21.1350. How much distance has occurred? The distance is 3.5 points. So if I look at this value and I double this value, which is about 6.5 points, if I'm going to enter more than double this value, then consider it oversold, overexhausted. Consider the trade not worth taking because it may not continue. There may not be enough sellers to push it forward down. So when I look at the 21.10 entry, I say to myself, well, will the market follow through and continue lower so I can be successful? And if this is more than double the distance based off of this value, which is about 6.5 points, forget it. Don't take the trade. It's too risky. So again, managing risk is based off of not just a hard stop, not just a hard target, which I'm showing you as well. There's a combination of ideas that go into it. Is it overbought? Is it oversold? As well, is the market more than 4 or 5 points on the ATR being extremely volatile, or is it too slow to trade? Now there's a question here about the stop being large, right, Rick? You're saying, you're risking a lot just to make 2.5 points. And I agree, right? Who wants to risk 5 points to make 2.5? I definitely don't. But you also have to consider, if you don't have a stop that is large enough to keep you in the trade, if the market goes up 2.5 points, which it could definitely do, and then goes and continues on to your target, you're out. You're out of the trade, and you should have stayed in the trade based on the volatility. So definitely don't look at this as using this one hard stop as the be-all, end-all of exits. Look at it as an idea to keep you in the trade to see it through. Leading to the next part of risk would be, why not use not just a hard stop, the 5 points that I'm recommending based on the current conditions, but let's use, in addition, other stop strategies, whichever happens first, to help you get out of the trade if it doesn't work. So what that means is you're using this 5-point catastrophic stop to keep you in the trade, and if there's a catastrophe, let's say the market just goes straight up to 5 points, then you're out. You're using that as the last resort. But instead, if this trade isn't going to work, we're going to have a total of 3 stop strategies, whichever happens first. The catastrophic stop is one that I just mentioned to you, which says, well, if the market goes right against me, I'm out. This is the maximum I'm about to lose. And if you can't take the 5-point risk when trading, then I would say don't trade. Trade when the market is a little bit slower and you risk less. Instead of just using this catastrophic stop, there's also what I call a time-based stop. And a time-based stop is a little different for the methods that I teach in the Atlas line. It would be 4 bars after you enter. So let's say that the market begins to chop around, right? It's normal, right? The market goes up, market goes down, like this. And at the end of 4 bars, 20 minutes, we're using a 5-minute chart, the market decides to just become a big chop and range. That's it. I tried to go short. The market never made my target, never made the stop. It's in a whipsaw type of category. At the close of the 4th bar, that's why I have the bar timer, you're out. You're done with the trade. You're not concerned about holding on to it. You've given it enough time. This time-based stop is not a break even. It's not the full 5-point loss. It's not even the full target. It's anywhere in between. So what that time-based stop allows you to do is limit your exposure in the market and your risk. The longer you hold on to a trade, absolutely the worse off you are, hoping that it's going to continue in your favor. So at the end of 4 candles, this could be a break-even trade. This could be a small winner. This could be a small loss. This could almost be making your full 2.5, 2 3/4 points. It could be almost reaching this area. But regardless, you're out of the trade. Most trades, the good thing about most trades is that they don't have this catastrophic stop. Definitely you're going to see them. It's not out of the realm that it won't happen. But I would say 90% of the time, this stop will never, ever get hit. Instead, you get out of the trade with a time-based stop, the target, or even the prove-it stop, which is the next part of making risk an integral part of what you're doing. If time is moving forward and you don't have your stop and you don't have your target. But instead, the market begins to reverse and close above the Atlas line. I call that the prove it stop. So I'm exiting this trade at a smaller loss because it's proving to me, that's why I call it a prove it stop, that it's not going in my favor. So immediately when the candle closes on the opposite side of the Atlas line, it's out. You're out. So that's a prove it stop. So you have here 3 stops to protect you. You have a specific target. This doesn't get hit all the time. You're going to see it, but it's about 10% out of the time you may get that. And be lucky that you have this, because this is the maximum loss that you're ever going to incur on the trade. Instead, if the trade doesn't work, it may even be a winner with a time-based stop or a smaller loss with a prove it stop. So you can see how I'm managing risk, not just, okay, every trade is a 1-point loss. No, I'm managing trade with a target based off of exact numbers. I'm having a stop which is also based on exact numbers. I'm using, in addition, if this never happens, either target or stop, I have a time-based stop to get me out 20 minutes, and I have a prove it stop for a smaller loss. So really, it's important to enter as close as possible to the Atlas line, or it's important to enter as close as possible to where it's breaking out, because your risk and your exposure is much smaller. Okay, so that's the way that I teach. That's what most of the methods, whether it be power price action, the Atlas line, the trade scalper uses a little bit different on the time-based stop, but essentially there's multiple stops as well with the scalper method. So everything that I do is not just, okay, watch the moving average cross, go in, always risk the same 1 point. How in the world can you dictate a specific like that when the market is always changing? You can't. You really can't. And so let's say, I mean, we're looking at a live market right now. Let's say that you entered short, not here where the actual entry occurred, but let's say you entered here for whatever reason. Look at how the market moved 2.5 points, whipsawing you. Now, think about everything that I've just taught you. If you have a stop that is less than this, you've been stopped out already 2, 3, 4 times. If you have a stop that you understand should be more than the current conditions, you're still in this trade. And at the close of the 4th candle, 1, 2, 3, 4, well, it's not, we're not there yet. If it hasn't reached the target, whatever the case may be, you're out. So you can see that a stop has to be relative to the current conditions. The target, when you enter here, made and went to exactly there, which, believe it or not, forecast the exact 2.5 points. So if you look at everything that I've predicted in a sense, or if I've analyzed, or I would say, if anything, understood about what I'm about to do, it's all laid out in front of you. And I think this is important. As a trader, you just can't jump in hoping it's going to happen. You enter into a trade with as much information as possible, and if the risk is too much, you don't take the trade. That's right. So Lewis has a great question. Let me just forward that to everyone. So Lewis says here, so based on those stops, wouldn't you need a higher percentage of win ratio to make sure your trading plan works in your favor over time? Based on everything that I've showed you, if you take just the stop, the catastrophic stop, I agree. You have to have a really high percentage of winners in order for you to get ahead, because you have one hard stop, this 2 times the ATR, which if you're only using that win, lose, or draw, I agree. You have to have a really high percentage of winners. But under the conditions that I'm showing you, if you have a time-based stop 50% of the time, you have a prove it stop 10% of the time, you have the catastrophic stop 10% of the time. You have the full 1 times the ATR 30% of the time. These are just numbers that I'm throwing out there. You don't have to have your percentage of winners being 99% to get ahead, because your winners could be a time-based stop, or it could be a break-even trade, or it could be a small loss. Your prove-it stop could be a small loss. This doesn't happen quite that often, and you're even forgetting that the target is made a high percentage of the time to begin with. So it's not as easy as saying I have one number for a stop and I have one number for a target. You have these other circumstances that take shape when calculating those values of win-loss over time. All right, Lewis? Do you have a follow-up question for that? Corey or Kevin, Jack, Ron, Maureen, Parminder? So I want you to understand the way that I'm approaching the market is not just stop, target, percentage, win-loss values. There's so much more to take into account. Let's take a look at something else. When it comes to risk, you should not be trading the first 5 minutes of the session. You shouldn't also be trading the last, let's say, half hour, 20 minutes of the session. And I'm going to give you another example. The example, let me just add another chart here. Okay, so here is a euro currency. So what happens, and I have the ATR here. This is the trade scalper method, by the way. So let's talk a little bit about risk when you're looking at scalping. If you look at the first 5 minutes of the day or the session, usually you can consider, whether it's the E-mini, it's the euro, it's a stock, you can consider it to be higher than normal volatility. So when the session opens, it's almost as if everyone just jumps in and buys. Typically, you have very small stops on the trade scalper method, and if you know that there's a huge amount of activity happening right as the market opens, then I have to say stay out of the market until 5-10 minutes is over. The same thing if you look at the last 20 minutes of the session. You typically have a squeeze on day traders, and the squeeze is because everyone's trading on margin and everybody begins to get out of the market immediately, just closing out positions, and that accelerates the market. So if you look at the last, let me just take a look at yesterday just to give you an example. If you look at the last half hour, 20 minutes of the session, here there's usually, you see there, this may be based off the FOMC, but there's usually a spike as the market comes to a close, and that's because everyone is getting out at market. They're just closing out positions without any regards to anything. So be very careful as far as trading with this risk idea the last 20 minutes, half an hour, because it's unpredictable. And the same thing here, right as the market opens, the first 5 minutes, you can see how there's a huge amount of activity as everyone jumps in. So this is a huge problem. Don't think it's the same. Markets are different in the beginning of the day as opposed to the middle of the day and at the end of the day. I like to trail stops, Lewis, under certain conditions. So when you trail a stop, the best thing to do, first of all, is know when the idea of trailing stops works as opposed to when it doesn't work. So the way that I like to trail a stop is to first realize that the market has to be a little bit more volatile than normal. I've never seen when the market is slow, right? So you're looking at here closer to 1 point that there's a trend. It usually doesn't happen. It usually happens when the market is more active. So first, let's take a look at when the market is more active. I would say to you closer to 3 points. We're looking at, higher than normal volatility. Market can definitely be trending. when the market is at 3 or above, which is 12 ticks. Okay, so first you got to say, let me only trail a stop when the market is more active. Can't really trail a stop when it's slow because it chops around. So if I know the market is a little bit more volatile, let's maybe take a trailing stop. So when you want to trail a stop, most traders, let me just go here into the future, most traders, what they do is they say, you know, I'm going to go in here at 21.12, just make these numbers, or 21.10, right? So make the numbers easy to understand. And when I go long and the market is in my favor, let's say my stop is down here, I immediately move my stop to where I entered because I don't want to lose any money. This is how most traders look at trailing stops. Everybody agrees, right? This is common practice. It goes in your favor, right? The market starts moving in your favor. What do? You immediately place your stop closer to where you entered. But when I look at this trailing stop idea, this concept, I really prefer to not just give it back if it happens to turn around, because, again, here we go with the ATR, average true range, if I know the market can make 2.5 points, isn't it true that if it went 2.5 points up, it could also go 2.5 points down, and I'm just out of my current position? The trailing stop was meaningless at that point. So this is very common. You're trailing a stop, you're putting the trailing stop too close, which in all circumstances most likely will get you just out of the trade with nothing to show for it. I don't do that, okay? I do something else completely. I look at entering, whether it's the Atlas lines, the power price action, it's the blueprints, the roadmap, these are all the methods that I teach. The ATR has to be a little bit higher than normal, and then I like to enter with 2 contracts or multiples of 2. So 2, 4, 6, 8, 10. So when I enter at 21.10, let's say that this happens to be the entry on whatever signal you're looking to go long at. 21.10, as soon as the market makes 1 times the ATR, so let's say it's 3 points, 21.13, of your position is removed. So once the market makes 1 times the ATR, consider the 1 contract. If you have 2, consider 1 contract off the table. So you start off at 2010, market makes 1 times the ATR, which is the anticipated target, right, based on the current conditions. Let's say it's 3 points. Half of your position is taken off. You're left with half remaining or 1 contract. Everybody okay with that so far? Let me know. Bob, you okay with that? Phil? Maureen, Ron, Rick, Corey, okay. So start off with multiples of 2. 1 times the ATR, half of your position, you take your profit. You're left with half of your position still remaining. So this 1 contract, half of my position that I'm holding on to, what I like to do instead is move my stop, whether it's the catastrophic stop, whether it's, I teach different types of stops depending on the setups. Like roadmap uses a different type of stop. The Atlas line has, in addition to what I just showed you, has pivotal stops as well for pullback and strength trades. So under these circumstances, if my stop happens to be, as an example, 5 points, 2 times the ATR up to 5 points, there's no reason for me to have the stop here all the way down here. Instead, I'm going to move this stop equal in the opposite position to the profit that I made. So I mentioned to you that I made 3 points on the first half of my position because the ATR was 3. My stop now is moved up to 3 points equal to the target I made. What that means is you're giving enough room for the price, if it needs to come down and breathe a little bit before heading up, you're giving that a chance to actually work. If you have your stop here after you take half of your position off the table, in reality, the same thing could happen. That remainder half of your position could equally go down 3 points as it did go up 3 points. So you're just giving back, well, not really giving back, but you're actually just letting that remainder one contract, half your position, get stopped out because you're putting it too close and too tight. But if you place the stop equal to the profit you made, but on the opposite side, you have a total of 6 points, 3 and 3, right, for it to breathe. If the market comes down and touches this stop, do you know what that outcome is? 0. You didn't make any money and you didn't lose any money, which is really much more important. So if you are deciding to have a stop that is tighter and closer and smaller than this, whatever this happens to be at the time that you enter, then you can expect it to flop around and potentially knock you out, get you out of the trade. But if you implore these rules, even though it's a possibility that's going to come all the way back down, so what? You're giving this an actual chance to work, and the best part about it is you just have to pay for the commissions to your broker, whether that's $2 or $3, which is not really, in the bigger scheme of things, the problem. The problem is large losses. And in this case, you're limiting yourself to $0, and you're limiting yourself to giving this trailing stop a chance to work. Now, once it moves 2 times the ATR, right? Why not move that stop up, right? There's no necessity to have the stop this large. So if the market continues higher and just keeps on going, move this now to where you entered. You're still behind the market with enough of the distance that if it needs to jump around or it needs to breathe, needs to pull back and retrace before continuing back up, you're still in this trade. If it goes 3 times the ATR, same thing. Now, I want to preface this or give this a little bit of a caveat. I would love to tell everyone that this is something that happens every day and this will always work, but let's face reality here. Trends don't happen. They happen very limited, and it has to be when the market is more volatile. Trending days only occur 15 to 20% out of the year. So if you're looking for a trend day in and day out, you're going to be disappointed. It's not going to give it to you. I can tell you that once the market shows me that it's in a trend with the ATR being higher, this is great to use. But don't consider 10 points, 20 points, 40 points as an option. Once the market makes 2 or 3 times the ATR, get out. Take your profit and move on. 3 times the ATR is 12 points. And that's just one contract. Are you going to give that up in the event that the market may turn around and stop you out and you're going to give back most of what you made? I'll tell you, on the E-mini S&P, 6 points is very normal for the market to move before deciding whether it wants to continue or reverse. So 3 times the ATR is a great way to say, I made 3 on half of my position, I made 9 on the second part of my position, I have 12 in total points. Go have some steak. Don't hold on to this trade thinking it's going to go 4 times the ATR, 5 times the ATR, because at that point you're really pushing it. Just take your money. So my recommendation is 3 times, maybe even 4 times the ATR, really the max. That's enough. You don't have to be greedy. Trading isn't about greed. It's about being consistent. It's about trying to make as much money as possible on a day in and day out basis, and knowing as well to stay out when the conditions aren't right. And that's why I always say, look at the, this may be a trade right here in about 3 minutes, maybe. Looking at the risk as part of everything that you do. Lewis, that's to answer your question on trailing stops. Okay. LK, can the Atlas line be used on Renko charts? It can be used on Renko charts as well, LK. I can. Why don't you email me? I'll pull up some Renko charts with the times or with the values that you use for Renko, LK, and I can send you something that will, see if it works for you. All right, LK? Because that's very specific. So I'd rather answer you by email on that and give you examples. All right, anyone have any questions for me on trailing stops, on the risk, on overbought, oversold, on the multiple stops that are used on the way that I teach? And here you thought I was going to show you two moving averages optimized. That's not the way it should be. You really stay away from these indicators that you see here. These indicators here, except for this one. This one's a really good one, and so is this one. This one's a pretty good one too, which is mine. It's my at the open method indicator that I offer with mentorship. Those two are pretty good. But really, the really important one here that I want everyone to start using, whether you're part of Day Trade to Win or not, is this ATR. But everything else here, I have to say, is as far as how you want to optimize it and being successful, it's never going to work into the future. You got to use something a little bit more concrete. How many trades a day, Rick? I would say, depending on obviously the market and the movement, the Atlas line gives at least the minimum 1 trade a day. But in a trending situation, you can have 5, 6 trades. With the trade scalper, it's just trade after trade after trade. The news indicator, if you haven't downloaded it already, is a great way to know when news occurs. It's free. You can download it for free off of the free software section of Day Trade to Win. And I have it here in my chart. And that's an actual live news indicator which alerts you. You can have an alert sound with it when news is about to come out. And this actually saves me from jumping in when I'm not really paying attention. I forgot that there's an FOMC, or I forget that there's news at 11 or with the oil, or 10:30 with the oil, or housing, PPI, unemployment, all those high priority news events. You can have them on your chart and it'll definitely alert you a few minutes and seconds, if you want, before it actually comes out to say, all right, let me get out of the trade. And here's another example, what I was referring to with the ATR being the way that it is. 2.25 points. This next candle moved, I'll give you an exact, because I like to use exact values, 3.75 of a point. So if you have a stop that is equal to or less than this value, you're out. Whether you're long or short, you're out. But if you have a stop that is double this value up to, again, 5 points, you have a chance to stay in this trade. So I want you to actually see that markets just don't go up and down vertically. They go down, then up, then doji, almost another small candle up, and then down. And this one went down and then up. So look how many times with a small stop you could be knocked around. So I'm trying to have a chance to see the trade actually fulfill what it wants to do. I thought this was going to be a pullback trade, but it didn't trigger because it's not, according to the rules, didn't trigger. This now may be a long. Once 2 consecutive candles close above the Atlas line, you'll see a long trade. I don't use the volume indicator at all, Lewis. I don't use the histogram for volume. I don't use any type of volume. I think that the ATR in itself is enough to understand volatility. So I don't use anything else besides the bar timer and the ATR to help me understand the Atlas line, the trade scalper, the power price action, even the other methods that I teach in mentorship. Now the Fed chair is occurring tomorrow, so remember, it's not always listed, the Janet Yellen Fed chair currently, as a high priority news event. That is definitely something that I want you to realize can move the market as well. So Fed chair may not be listed as a red star, but she will say something like, I'm going to raise interest rates, or we're thinking, we're looking, we're contemplating, and boom, everybody says that means something. Everybody buys or sells at the market because of her intentions. Now, one last thing I want to mention to everyone is that the next group mentorship class begins October 19th. And so if you're interested in joining, please call me, make sure this is right for you. You can also visit DayTradeToWin.com and look at everything that's included with the group mentorship class. The Atlas line, the Trade Scalper, they're all lifetime licenses. They don't expire, and everything is installed for you if you need help with that. I have a staff that does that. And in addition, if you need NinjaTrader or if you need a charting platform, there's no reason to run out and get a broker. I can provide you and help you with live data for your charts while you're practicing at no cost. So that's a great benefit that we offer all of our traders. Anyone have any questions for me on the Atlas line, on the Trade Scalper, on anything that I taught, on risk, on joining the group mentorship class? Yeah, sure. So what you get with the group mentorship class is not only what you see on Day Trade to Win, but everything is recorded. You get your own video account, 8 weeks or more with me. The lifetime licenses, it's the at the open. Actually, let me show you the at the open indicator that's also included. You get the roadmap. There are a total of, I believe, 12 or 13 methods that are included with the mentorship program. So today on the At the Open, this is a short entry. And remember, if this entry is short, just to kind of give you a little synopsis on how to proceed, the ATR is at 3 points. That means a target of 2 3/4, a maximum catastrophic risk of 5 points, and your target is roughly about 3 points. So into the future, if this target isn't made, meaning to go short at this price, if it's not made within the next 4 candles, out of the trade. It could be break even, it could be small win, small loss. If this trade here goes straight up to 5 points within the next 4 candles, you're out of the trade. So that's how the trade management works. If you want to look at the ATO for yesterday, see how it did. The At the Open was the first method that I offered traders, I would say maybe 10 years ago. And here is the long signal yesterday. You're long at 21.3350. 1, 2, 3, 4. You're out of the trade. What was the target? The target was 2.5 points. Did it make 2.5 points? Let's take a look, right? So you're long. It made 3.5. Even if it did not make the 3.5 points, you're still out at a profit. So you can see how the At the Open course, which is it's a actual course that you receive, you understand how it works, and you get the software. That's included with the mentorship, either private or group. All right, and I'll show you one more for those of you who are asking. We'll go back the next day. Short, 21.46 1/4, and it speaks for itself. It's 2 points. Any questions whatsoever that you may have for me? All right. Please call or email if you do have any questions. I'm more than happy to speak with you. Make sure this is right for you. Classes get filled up very, very quickly, and I keep them very small. So a deposit gets you the At the Open course and software, sets you up, and October 19th we begin. 8 weeks. It's recorded. It happens to be something that I think is of great value for the price. Have a great rest of your day. Please reach out, and I will post this video in YouTube and on the blog for everyone to review, learn from, and be as successful as you can be. You got it, everybody. Thank you very much. Thanks again, Jack. Have a great day. Bye-bye now. Thank you.